Good afternoon, everyone. Thank you for joining us. My name is Skip Newberry, President and CEO of the Technology Association of Oregon. We thank you for joining us today. This program is brought to you by RGP as well as TAO. As I mentioned in a social media post last week, we have a lot of local companies such as Arcimoto and ZoomInfo that have recently gone public, and companies like ESS in Wilsonville. They recently went the SPAC route. And we have more member companies that are currently looking at both options. In this program today, we'll discuss what it takes to become public through either the IPO or SPAC route and strategies for ensuring success as a public company. Some brief housekeeping to cover before we dive in. We're recording today's session, and we encourage you to submit questions or comments via chat throughout the program. If we're unable to answer all the questions, we'll make sure to respond offline. And 1 CPE credit is available today. So to be eligible, we hope you'll participate for the duration of the program and respond to 3 polling questions. You'll receive a follow-up survey as well, and we appreciate any and all feedback you might provide. Please note that CPE certificates are distributed via email within a few weeks of the program. And without further ado, I'd like to introduce the first of our several panelists. We have Vicky with us today, as well as Bryan and Alisanne, and we'll be starting off with Vicky. The floor is yours.
Great, thank you so much, Skip, and welcome everyone. Certainly happy to kind of be able to give you guys all an overview of that journey to becoming public. Again, here are kind of the speakers that we'll have today. As for myself, I'm going to kick off our presentation today and really just be able to provide everyone with a general overview or highlight of the 2 roads that most companies are going public these days, the IPO and the SPAC route. And then I'll turn it over to Bryan, who will be providing the financial readiness and reporting pieces. And then Alisanne, she's going to cover the governance, controls, and compliance. So with that, just kicking off in terms of the 2 ways to go public. And before I really highlight just the differences, wanted to first kick off on really that motivation for going public. So obviously it's growth in the company. And again, there's a lot of prestige being a public company, but the best way too is really just finding ways to raise capital. And that could be to do business expansion, acquisition currency. So growth from obviously acquiring a company, so you're needing additional capital, or it could be you've got expansion from a geographic perspective. Maybe you need a bigger manufacturing footprint. Maybe there's new product launches. Another consideration too, after you've also become a public company, is it does provide you an advantage when it comes to improved credit worthiness. So you're certainly able to secure better terms from lenders, which will certainly help with the continued growth of your company. Another reason where many companies are aware of is just the partial exit for their current owners. So in a private company, as you keep growing, you're getting profit, the shareholders are going to certainly benefit. However, if you think about a brand value and a market goodwill perspective, a lot of that gets more monetized when the company goes public. So there's certainly an incentive for existing shareholders to also want to go public. And then one other area too for consideration is just kind of the increased brand appeal. As you're going down an IPO route, companies are certainly out there promoting, advertising the public offering. When you're on a SPAC as well, and now that you've become public, you're out there more in the marketplace. So it's definitely generating more of a buzz for your company and then really increasing that brand appeal. Now, after you kind of consider the fact that yes, going public is the way for growth for my company, there are a lot of issues and challenges to really consider. And this is kind of the area that we're really focused on today. First is that finance and accounting piece, and Bryan will go into more detail when we get to that point. But there's certainly financial reporting standards, accounting standards. You now need to be more compliant. You've got GAAP, you have SEC rules, and certainly the ongoing public obligations. So even though you're setting everything up to go public, there are a lot of requirements once you become public. So your company is really going to need to step up to be able to meet those requirements. The next area too, and this is where Alisanne will dive a little bit deeper in, is just the corporate governance standards, your compliance with Sarbanes-Oxley, and then what we're calling third line of defense, being able to set up that internal audit function and also working alongside the audit committees. And then another area too that shouldn't be forgotten is really just the system fitness, as well as improving on your continued business process evolution. So from a systems perspective, a lot of the private companies, you've got your basic system that you've been using. However, once you're going to have these SEC compliant reporting needs, your systems may not be able to handle all of the data and information, and therefore you're going to need to have an upgrade. Also, from a business process evolution, there are a lot of workarounds you can do just to get yourself ready to go public. But once you are public, you're going to have to take a step back again, readdress any potential workarounds, and really improve those, make those automated. Additionally, too, there's just in general process optimization so that you can continue to support the growth of your company. Now that your company is thinking, yes, I'm going to go down the public journey, there is the, are you going to do an IPO or a SPAC? And so wanted to kind of give a quick highlight on the comparison of the two. So obviously, as many of you already know, an IPO is you're a company that's looking for money. So you're going to be raising capital by offering shares in the public market. When we look at a SPAC is really just a shell company. So when you hear the word SPAC, it's just a company created from investor capital. The SPAC itself is actually going to go through its own IPO, and then they're going to raise capital. And the point of this capital is to make an acquisition in a company. So the SPAC itself essentially is money looking for a company. Now, as a private company, when you're thinking about the speed, the average speed to go public is about 12 to 18 months. And you as a company have control over kind of that timeline because it really is driven by your organizational readiness to go public. In a SPAC situation, you've got a shorter time frame. So once they decide to acquire you, you're looking at more of a 3 to 6 months from the point they want to acquire you to the point that you'll become public. The next area too is the marketing. So in an IPO, there's a lot more effort from executive management. You're going to be working alongside your underwriters to do the roadshow because you're really trying to just drive up the interest in the valuation of your company. In a SPAC situation, there's not generally a roadshow. If you have any roadshow, it's targeted because at the end, the SPAC's coming to acquire you. Any additional roadshows you might have is really just to generate interest from what we call pipes, private investment in public entities, and they'll be offering additional capital as part of the transaction. This really leads to the idea of the pricing. So from a pricing in an IPO, you really are dependent on that market condition. Whereas in a SPAC, again, you get to negotiate. SPAC's going to acquire you, so there's negotiation in terms of the pricing you're going to get. So there's a lot more of a known factor of the capital that you'll receive so that you can continue to grow. And another factor too is just the cost. IPO has a huge cost, especially when it comes to the underwriters as well as the roadshow. A lot of that too can be absorbed with the proceeds from the offering. On the flip side, with the SPAC, you're not going to have any of those high costs.
It looks like we might have lost Vicky temporarily. We are in New Jersey and we are having a storm at the moment. See if we can get her back on. Okay, looks like Vicky did drop. We'll get her back in. I am happy to share the presentation if you'd like. Keep moving.
Yeah, Nicole, I could probably pick up from where Vicky left off.
Perfect, thanks so much. Hold on one sec. Just let me know which slide to go to, please.
Sure. Head over to, keep going. Keep going. One more. Wait, back one. Okay. So I'm certainly no replacement for Vicky, but hello everyone, nice meeting everyone. So again, why have SPACs been so popular? Well, I think, it's one, as we all understand, is the speed to market. It's the ability to become a public company in a much shorter period of time without all that effort of going through the initial IPO process or that traditional IPO process. But it's also that ability for the private companies to negotiate that valuation really outside of that market aspect of the traditional IPO. So they're negotiating directly with the SPAC sponsor. And so it's really potentially an opportunity to maximize the value in those one-to-one negotiations rather than dealing with a larger market focus. Of course, as we just mentioned, it's also just, again, the quicker access to capital given the average time frame the public from a traditional IPO, 12 to 18 months, to a SPAC, which again is generally what we're seeing are 3 to 6 months. Very much a quicker path toward that public listing. And then just in terms of the ability to provide that forward-looking information, and I actually have some additional discussion in my slides later on around forward-looking statements, but its ability to tell that story. When the SPAC sponsor is negotiating with the target company, it's your ability to tell that story, again, one-on-one with that SPAC sponsor. And there is some general leeway, some safe harbors out there, if you will, around how forward-looking information projections are presented. So that certainly is an advantage for SPACs, whereas for IPOs, generally that's a very much more of a regulated area around how a public company going through an IPO through that traditional S1 process can present forward-looking information. Next slide, please. So in terms of the typical lifespan for an IPO, again, in the traditional IPO, it's a fair amount of planning that goes into it. One, we want to make sure really, are you ready and where are the gaps? And so we go through this assessment process. And in that assessment process, it is really determining where you're at with your financial readiness, your ability to function as a public company, if you will, from the makeup of your board, your governance, many factors. Then as we go into the IPO prep itself, 6 to 12 months prior, is the beginning to build out that team. In terms of the bankers, the investment bankers are an important decision around who you're going to bring to the table, who will be walking with you through that going public process. Preparing the fact book, the information, and the prospectus. It's telling the story of the company. As you go on, get ready for your roadshow, it's that consistent story that will make it be compelling to a potential investor. And then the IPO execution. It's pulling together what we like to refer to as the IPO program management. And the IPO program management is really the overall bringing together of the entire process. Because there are many external advisors involved in the process, along with the company personnel, we have found that having a program management focus helps to make sure that timelines are met, that all the necessary activities come together, and then we're able to watch that or observe that and control that in a well-controlled environment. So with that, under that IPO management, as I mentioned, we've got the financial readiness. It's the uplift of your financial statements to ensure that they're PCAOB compliant. And I'll talk a bit about that more here shortly. This also controls and compliance. Though there's not necessarily a requirement to be SOX compliant as you go public initially, there is certainly an expectation that the company has a set of internal controls that the financial statements are based upon or built upon. And then ultimately processes, operations, and the infrastructure, the systems, the technology supporting the business, whether it's your ERP, your accounting system, the investor relations, the ability to close your books timely. All those are really important areas as we move into the execution stage and ultimately, and then post-IPO, generating the value as a public company. Next slide, please. In regards to SPACs is very, very different from the standpoint of we already have this public entity of the SPAC looking to identify that appropriate target, the operating company, if you will, to achieve an operating public company together. So the negotiation begins fairly quickly once the SPAC has gone public and begins to look for targets. So once that target is identified, then of course there's a negotiation of the value. At what price is the SPAC going to acquire that target or targets? And part of that, of course, then supporting that negotiation is the public company readiness assessment as well. What is going to be needed to support that or have that company, that target, ready to become a public company? And then as we get through that public company readiness, and that's part of that is developing the S4, which is, again, I'll talk about that here momentarily. But then once we get through that whole S4 filing process with the SEC, we get clearance on that. Then typically the deal closes, the transaction is completed, and you become a public company going forward. Next slide, please. So key challenges, diligence. For here, it's really the consideration of what is the right candidate for the SPAC. A lot of SPACs we've noted are really specialized. Some are focused on just on technology companies. Others are in the healthcare. We're starting to see SPACs in the REIT space, so looking solely at real estate. So a lot of that consideration then needs to go toward ultimately your ability to be ready to execute upon that. And part of that is the readiness. Identifying, again, the gaps and then the needs and preparing to become public in a very accelerated time frame. It's also being able to comply with the regulatory and legal aspects of becoming a public company. Part of that is very often you're going to have to quickly become SOX ready. Whereas if you're going through a traditional IPO, you've got time to sort of evaluate what processes you're going to that you need to develop to be able to that you need to address from an internal control or financial reporting perspective. But then also ultimately with the SPACs, you may be in that position as you complete the deal and you become a public, you have a very short turnaround where you may begin to have to comply. At minimum, you have the 302 and 906 certifications, which are the CEO and CFO certifications. So often, even before you be required to become SOX under 404, which is that traditional, or what we expect or understand as that traditional audit of your internal controls, there is still an expectation that you have a set of internal controls that both the CEO and CFO can certify. And then from a readiness perspective of the financial reporting, is being able to prepare the annual and the interim financial statements, the pro forma information that may be required as we go through the S4 process in anticipation of completing the transaction, developing the MD&A and all the market risk disclosures. There's a fair amount of information that has to be pulled together in a very short period of time. And so having a dedicated team help you with that is an invaluable exercise in ensuring that the transaction is completed timely and successfully. I think in the interest of time, I'm going to quickly go through this one. So other considerations that we often see with SPACs, as well as the general traditional IPO, is around tax. For a lot of companies, as they go public, one of the requirements, of course, of becoming a public company are your quarterly 10Qs. And so one of the areas that requires a lot of attention is quarterizing the tax provision and being able to make sure that the tax information can be disclosed and properly reported upon on that quarterly basis. Similarly, SEC filings, quarterly the 10Q, annual 10K, the deadlines around those. And then of course also 8Ks. There's a whole laundry list of 8Ks that are required to be filed depending upon the transaction type and the general amount of time that you would have to file those. All those come into really more importance from the standpoint of maintaining your ability to continue as a registered or as a listed company. Both the NASDAQ and NYSE require you to have current SEC filing. So again, those as an area, as an additional consideration, making sure you have the processes, the people, the technology in place to support those timely filings. Governance, both the NASDAQ and the NYSE require a certain amount of independent directors. So the structure of your board and your various committees under the board are important that they have those independent types of board members. Also, I mentioned already IT, having the appropriate ERP in place to support being a public company. And then equity and comp. This is another area that we often see where companies really need a lot of support around their stock compensation plans. Being able to timely prepare the necessary valuations and the reporting requirements required for those types of that type of equity. Next slide, please. All right, we're up to our question number 1 for polling. Does your company have plans to go public via an IPO or a SPAC? I'll give you about 60 seconds to respond. And I did get confirmation that Vicky lost power.
Hi, everyone. I actually just was able to join over the phone. We laughed about the storm might take my power out, not thinking it actually would.
As I told him, Vicky, I'm certainly a substitute for you.
And you did awesome. I was able to hear the last sentence. So thanks so much for covering, Brian. I appreciate it.
Sure. Are we ready to move on? Oh, great. There's the results. All right. So we have about 24% say they're interested in going public, but no immediate plans. Interesting. So the combined results of yes via IPO, via SPAC, or considering is about 40%. So that's great to hear. And no, the rest of you just here for the CPE credit, and I get that. Very, very interesting. Thanks, guys. I think we're ready to move on to the financial readiness. Oop, and I just lost my screen. Hold on. All right. Okay. So in terms of the financial statement requirements, reporting requirements as well. So in terms of the going public process, the traditional IPO, we file that initial prospectus and information on the Form S-1. In a SPAC merger, that's filed via an S-4. And the reason it's typically filed on S-4 is that often, not only is it a proxy statement, but because there's often new additional securities being offered as part of the merger, that PIPE transaction. In terms of the financial statements themselves, here's where there are definitely some differences. So of course, the traditional IPO, the requirements are the financial statements of the entity that's going public, and as well as any acquired businesses as if they're required by Rule 305 of Regulation SX of the SEC. In terms of the SPAC merger, it's not only the financial statements of the target company, but it's also the financial statements of the SPAC sponsor, as well as any acquired businesses. And all of these, in both cases, have to be audited in accordance with the PCAOB audit standards. Now, what are those differences? Most private companies have their audits performed effectively under what we refer to as an AICPA standard. So in terms of public companies are required to be audited by PCAOB registered and inspected auditors. So the differences are typically under the PCAOB audit standard, it's a much deeper scope of audit. And so all the transactions, the balance sheet, the income statement have a much deeper focus. And so more often than not, there are some adjustments that come out of that process. In terms of the number of periods required, early growth, if you're able to qualify under the early growth company standards of the SEC, there's only 2 years of historical financial statements required. For all those that don't qualify under the early growth company standards, then it's 3 years. That's in both for the traditional IPO and the SPAC. And depending upon the timing of the going public, you may have to provide unaudited interim statements also in compliance with the PCAOB and SEC reporting standards. Now, typically what we'll see is if you go public early in the year, or you're able to complete your merger early in the year, then those interims aren't required. The date is what's driven is when the 134 days have passed since the date of your financial statements for the last filing. At that point, those financial statements, what they call go stale. So then you would need a certain period or number of interim periods, whether it's your first quarter or second quarter or even third quarter. As well as in both cases, management's discussion and analysis. This is basically describing and analyzing the results of your operations to the public in both of these filings. One additional requirement in a SPAC merger on the S4 is the preparation and disclosure of the pro forma financial statements, as if the SPAC sponsor targets have completed their transaction. You can go ahead and jump to the next slide, please. In terms of the private versus public accounting standards, so for both the traditional IPO and a SPAC, the financial statements must be developed in accordance with the SEC reporting requirements, what we refer to as Regulation SX. As well as there are certain US GAAP requirements that are only applicable to public companies. Now, some of the areas that we typically see that have to be reflected or adjusted to reflect the SEC reporting requirements are around income taxes, namely around the rate reconciliation disclosure, how related parties transactions may be disclosed. And then really these next three areas are really also probably the biggest areas that we see that require a fair amount of work, and that's around segment reporting, as well as earnings per share. And earnings per share can get pretty complex, especially if you have multiple classes of common stock. And so that area is one of the areas that we tend to spend a fair amount of time uplifting or preparing to be as part of that public company reporting requirements. And another area that we see a lot is around redeemable preferred stock. Traditionally, if you meet certain rules under private companies, you can keep that redeemable preferred stock down in your equity section if it's not classified as a liability. Under the SEC rules, they do have their own unique way to present, and that's what we call the mezzanine equity. So basically, that redeemable preferred stock gets presented between the liability section and the equity section, hence the name mezzanine equity. And then finally, there are certain private company alternatives that must be unwound. So a fair amount of private companies will adopt accounting standards and elect some private company alternatives. One of those areas is goodwill. Private companies are permitted to amortize goodwill. Well, once you go public, you must unwind that transaction from the date that you initiated that, those private company alternatives. So that, again, that's part of that uplift of those financial statements to be compliant with the SEC. And then, of course, finally, any adoption of any new accounting standards. Typically, the FASB has requirements, different requirements between public company adoption dates and private company adoption dates. So as you become public, most new accounting standards that have been released would be required to be adopted. And I'll just quickly mention one area that we've seen a fair amount of issues with on SPACs, and that's determining the accounting acquirer. If a SPAC acquires the target in an all-cash deal, then typically the SPAC will be the accounting acquirer. If it's a mix of equity and cash, then that's really kind of complicates the situation. But why does this really matter? Well, if the SPAC is the accounting acquirer, then it's deemed to be a business combination. And then the target company, you would effectively have to revalue or remeasure your assets and liabilities under the GAAP requirements of a business combination. If the target is the accounting acquirer, then it's that traditional reverse merger, that reverse capitalization. Really one of the reasons why we headed down the SPAC path, if you will. And it's far less onerous to achieve that, the accounting results when we are able to establish that the target is the accounting acquirer. Next. In terms of the activities across the SPAC timeline, as Vicky had mentioned earlier, typically a SPAC is a 3 to 6 month exercise. And this gives you kind of a summary of what that process looks like. Really in that prep stage, getting you ready, doing that assessment, identifying those gaps and areas that you need to prepare or work on that will need to be worked on in anticipation of preparing that Form S-4. As we move into the S-4, typically about a 2-month process. It's preparing your SX compliant financial statements so they can be audited by your auditors. It's making sure that the tax provisions are prepared in accordance with the SEC reporting and US GAAP requirements. It's any interim financial statements as well as any selected financial data that may be required. Now we've had some recent changes from the SEC recently that has done away with a certain amount of selected financial data. So that is certainly a welcome relief from the SEC this past year. But all you must prepare the MD&A. And then one of the other big areas that does take a fair amount of effort as well is preparing those pro formas. Again, that combination of the target plus the SPAC sponsor. And then once the S-4 is filed with the SEC, then there's a period that the SEC has to review that filing and provide any comments. And then there's essentially an answer period or response period to those SEC comments. So we'll update the S-4 and refile it. And then once we get the essentially the AOK, if you will, from the SEC, we become effective. At that point, fairly quickly, the transaction closes. That is, the SPAC sponsor acquires the target. And then within 4 days, what we refer to as the Super 8K must be filed, which essentially announces the merger completion and includes a fair amount of information around the combined companies. Next slide, please. And this just gives you another view of really kind of the same information. Let's go ahead and move on to the last one of my section anyway. So one of the areas that a lot of you may have seen in the news is around accounting for SPAC warrants. What basically occurred is back in April, the SEC issued a staff statement noting some of their concerns of how SPACs accounted for warrants that were issued in the SPAC process. And their concern was that they noted that there was some specific provisions in these warrants that really didn't quite say, hey, these aren't really equity instruments. They really should be treated as a liability. And what we've seen is a lot of SPACs going through restatements and as well as filing amended 10Qs and 10Ks. As part of that amendment process of refiling their Ks and Qs, it's resulted in a number of the exchanges, both the NYSE and the NASDAQ, issuing non-compliance notices. And so a lot of that business needs to be taken care of before the target acquisition can be completed. So there's a lot of activity right now in the SPAC space of these SPACs going through amendments and getting those refiled. Another area I want to mention that's been in the news lately is around safe harbor. Traditionally, there's been a bit of a carve out, at least a perception of a carve out around blank check companies in terms of their forward-looking statements. Certain SEC rules or law around safe harbor didn't necessarily apply to, or they had safe harbor, if you will. Well, the acting director of Corp Fin at the SEC put out basically a warning last month saying that he didn't perceive that there is necessarily a safe harbor for forward-looking statements. And what I'm referring to on forward-looking statements are really around company projections that are often included in the S4 or really around the sales process. And what they're trying to point out is that there may not be such a safe harbor, and you shouldn't assume that there is. In fact, the US House just a couple of weeks ago issued some draft legislation that will close any perceived loopholes around safe harbor on forward-looking statements in a reverse merger or through a SPAC merger. Then finally, I just want to remind everyone that staff will not review incomplete registration statements. And so even though there is an accelerated timeline, they do have to be fully complete S4s. Same thing with the S1, you can't really file an incomplete registration statement. They will be rejected, the SEC will not review, and that will slow down the process. I think we have a polling question now. Has your company begun the process of preparing to go public? Yes, no, or not applicable? And our responses. Well, I think that's pretty consistent with what we saw with the first polling question. So 31% are saying yes, they are beginning the process. Another 27% are no, not quite ready or not ready to begin the process. And 42% are saying not applicable. Maybe you're public already, or you just have no desire to go public. Thank you very much, everyone, for those responses. Next, I'm going to hand it over to Alisanne, who's going to walk us through some governance.
Yes, good afternoon, everyone. I'm Alisanne Gilmore Allen from RGP. I'm in the Enterprise Risk Service or Internal Audit Services and Compliance Group, and helping companies put their controls in place pre-IPO, with SPAC, etc. So we're going to talk just a little bit about that. If you want to go ahead and move to the next slide. What is SOX and why is it important? Why should you care? Probably most of you already know that SOX is required, or internal controls are required of public companies. And once the company does go public, either via SPAC, the first quarter after, once you're acquired after filing, or through the IPO process, you will need to have a quarterly certification by your CEO and CFO regarding having certain controls in place around disclosure controls and procedures, that everything is complete and accurate within your financial statements. And then ultimately, Section 404 will become applicable. It may be, the second 10K after the company goes public, but management needs to be responsible for internal controls over financial reporting. And when the company reaches a certain size of market cap of $1 billion or more, or has been in business for over 5 years, depending on the revenues, the external auditors will also need to give an opinion on the internal control structure. So, if you're in the stage where you're thinking about an IPO or thinking about SPAC, it's worthwhile to also at the same time begin the process to think about what sort of internal controls do you need and want to have over your financial statements. So this is not something that the external auditors make up, but the public accounting, PCAOB, or the Public Company Accounting Oversight Board, makes decisions on the requirements, and then companies are obligated to comply. And if you don't comply, you certify that you've got controls in place, your CEO or your CFO potentially has the risk of fines or going to jail, and you probably don't want to see your CFO and CEO in jail stripes. It also could impact your, just the public perception of your company. So it's just a, reputation risk that you want to think about. And it does have real penalties. I've helped companies where we've come in after officers have been identified and have had to spend some jail time. Go ahead to the next slide, please. So this just gives a little bit more of a background on SOX. I'm actually not going to spend much time on that. So I think I've talked about some of that. Go ahead to the next slide, please. So here is where you've got sections 302 and 404. The 302 is the CEO and CFO certification of disclosure controls. And as I noted, the filing was the first quarterly filing after your IPO via either SPAC or IPO. And then this 404A and B is just a little additional definition. So let's move on, please. So basically, in terms of getting ready, what do you really need to think about? What does this look like? What it typically means would be to do or have someone partner with you to perform a risk assessment, to look at your financials and determine what could be material to the financial statements. Is it revenues? Is it your costs? Is it things around, whatever it is, your, accruals that you're doing in terms of, clinical trials or whatnot, but you need to identify what are the risky areas that you need to have internal controls around. So we would typically do a risk assessment, identify the processes, and then help you to develop narratives that would describe what your processes are and identify key controls that would be put in place to reduce the risk of any sort of a financial statement misstatement. You want to think about it in terms of your overall corporate governance controls. Companies, when they file their 10K, are responsible to note what is the structure or the framework that you're using, or the basis in terms of how you're evaluating internal controls. And most companies in the US choose to use the COSO 2000 framework. You can use another one, and that's fine. If you do, you just need to articulate that in your 10K, and you or your service provider that's working with you would need to help identify what are the controls that are required, for example, within COSO corporate governance or the other that you've chosen, and that you do have controls in place to recommend those risks. And then we recommend improvements, make sure your documentation is in order. You don't need to do a lot of testing at this phase if you're not yet public. But once you do go public, or depending on the comfort level of your CFO and your CEO, you may want to start to do a little bit of testing just to say, okay, we've identified these controls around maybe financial close and reporting, and do a little bit of testing to make sure that the documentation does support effective operation of the controls. So those are the kinds of things that we typically would engage with you, or that you would want to think about in terms of just getting ready to go public. So in addition to all those financial statement readiness things that Bryan and Vicky talked about, thinking about internal controls is definitely going to help you. And if you do it pre-IPO, it just makes a little bit less of a fire drill, once you've actually gone public, and then you're starting to have certification requirements for your chief executive and your CFO people. Let's see what else is here. This is just a little bit of a control and compliance timeline to help you think about when, sort of your IPO planning exercises, and then your 302, 906 certifications, which once you start that, they go on quarterly. And then your second 10K would show, your 404 assessment, and that's when you really want to be doing testing of all of your controls to make sure that they're operating correctly, or if they're not, that you've got mitigations to address it, or your audit committees are made aware if you in fact have an ineffective control environment. Are there any questions? So this is the last slide that just gives you some examples of some dates. If you had a SPAC date or an IPO date, for example, of January 15th, your merger date might be, not until July. The first quarter after the merger is when you start to be required to actually have quarterly certification. So in that first case, it's 77 days. You got a longer runway. In the second case, if your SPAC or IPO date is November 15th, your merger date is 9/15. From 9/15 to 9/30, you've only got 15 days. So you could have a pretty short timeline from when you actually, go public to when you actually need to start certifying, or your officers need to start certifying on the effectiveness of controls. And similarly, you can see that the timeline in terms of your first 404 assessment, it could be, little over 3 months, that 107 days in that first example, or it could be, closer to 2 years, depending on the timing. So timing is an important consideration in terms of just thinking about your control environment and when will you need to certify compliance and demonstrate that you've got controls operating effectively. I think we may next have a polling question. So do you plan to engage any external firms to help you with your readiness? And we're interested in knowing if you do and you're ready to get started, or you probably will, but you're not ready, not there yet, or definitely not, or you don't know. So after we get the polling results, I guess we have a few minutes for some questions if anyone has any. So we're getting some responses. Hopefully people are getting a chance. If they want their CPE credit, we definitely want to have you answer the question. Oh, there we go. So it sounds like yes, about 12% are yes, they're going to need some help and they want to get going soon, 12%. And then another quarter of the audience is, yes, you do anticipate needing help, but you're not quite ready for that. So probably not within the next 3 months. And then the balance, it's not sure or not applicable. You may not be in a position where you're actually going to be going public and needing any help. So thank you for your answers on this. This is super helpful for us to know. And I guess we're at the point where if people have questions, they can put them in the chat or
All right. Well, thank you,
I have a quick question. Sorry,
Bryan and Vicky. Yes,
sorry.
Go for it. Jump in.
Took me a little while to figure out how to get myself off mute. I'll do my camera. Hey, everyone. So in understanding the difference between IPO and SPAC, it sounds like a lot of the difference is pre-listing, and it's quicker and perhaps it's known to be less involved than an IPO listing. So what's the downside? Does the market punish you for taking the easy way out? Or why would someone choose to go the 18 to 24 month route versus the 3 to 6 month route and go through the process of preparing an S1 versus an S4, et cetera?
Bryan, are you able to answer that one?
Sure. I don't know if Vicky was on the call or not, but I think some of the downsides is often the SPACs are bringing in, will bring in a certain amount of management, if you will, and influence in the process. And the traditional IPO, you have a little bit more control around who you're selecting for your board, some of your governance, other aspects of your governance. I think another area, maybe this is a little bit more anecdotal of what I've seen is because that part of that valuation that is negotiated between the SPAC sponsor and the target. We've seen some of that, right after, briefly after going public, there's a dip in the value of the price. I've not seen or been able to study it from a long-term perspective. If it's a permanent decline, if you will, or a longer-term trend decline. But I think with the traditional IPO, there's generally a closer to what the expected value when you come out of get your first listing, your first day of trading.
God, that's helpful. Thank you.
All right, any other questions for the panelists? I have one. One thing that was striking to me was the over 20% of companies that said that they hadn't quite decided or made up their minds yet between a SPAC or an IPO, but were planning to go public at some point soon. I think it was Alisanne who had mentioned that internal controls is one thing that you can never start too early in terms of preparing. So if companies are kind of on the fence between either a SPAC or an IPO, are there other areas that companies you'd recommend look at as soon as possible, besides just internal controls as they're preparing to go public?
Yes, I would say think about your messaging. I think an area that's often forgotten is investor relations and telling the story effectively, if you will. I think that's an area that's often forgotten until after you're listed. I think bringing an investor relations group in early to help refine that messaging and bring that together can be pretty beneficial to the market. Another area, often the area I see is really looking at your IT systems. There are mid-tier systems that are reasonably cost-effective that work well in that space, that provides you the internal controls. I know it's a little bit of internal control bent to the answer, but does give you some internal control advantages. And we do see a fair amount of really small companies that are starting through the SPAC process that are QuickBooks based or relying heavily on Excel for their accounting support. And from sort of internal controls going forward, that's just an area that won't be seen very effective from a control perspective going forward.
Excellent. We've got a couple other questions that were just popped into chat here. First one is from Ryan Smith. What is the most common stumble companies make?
And this is Vicky, back on again. I will say, I think one of the biggest stumbles is companies just aren't really thinking how much they need to prepare and not kind of addressing things early on. And I think one key area too is as companies are looking to start that journey is think about who you can find as a point person, whether that's internal or external, to really be that overall program manager for the process. Because there's a number of work streams that are going to be going on, a lot of coordination with external firms, your lawyers, if you're going IPO route, your underwriters, your auditors, additional consultants to kind of come in. So really having that point person as well to really help shepherd the whole journey is very key. And again, the most important thing is just starting earlier than later.
Excellent. And we have one other from Don McGrath. Is there a difference in what you are seeing in the marketplace when it comes to the revenue run rate of companies utilizing SPAC versus IPO this year?
If I understand the question correctly, I think you're probably seeing, there are some SPACs that are very, very, very early stage revenue, whereas I would typically expect a company going through the traditional IPO path to have already established some revenue stream that would certainly help support, the pricing on that traditional IPO market roadshow process. That would be one thing I've noted.
Great. I think we might have time for one more quick question. All right, well, I have one. If folks think of something after the fact, what's the best way that they can get into contact with the panelists?
I'm happy to take that. Hi, everybody. I'm Pam Mudge. I'm actually local to the Portland market and a member of TAO, so I know Skip very well. You're always welcome to reach out to me. I will actually be sending all of you an email after this event that has both the survey along with this deck and my email address. So if you want to reply to that email, I'm happy to connect you with any of the panelists or set up time with you to discuss your specific needs. You can also always go to rgp.com. We actually have a place on our website that has more information about our public readiness offerings that also has a contact us element as well.
Great. Thank you, Pamela, and thank you as well to our panelists, Vicky, Bryan, and Alisanne. It's great to have Vicky back on, even if only by audio. This is the first Zoom call I've been involved with where a thunderstorm took out one of the panelists, so at least the power. So thank you to everyone who joined us today for this session. I know I found it very informative, and it's a hot topic among a lot of our member companies here. So thank you everyone for attending, and thank you again to RGP and the panelists for sharing some knowledge with us. We appreciate it.
Thank you, everyone.
Thank you.
Thank you.